Manish Sonthalia, Motilal Oswal AMC joins us live. Manish, good to have you back on ET Now. Thank you for joining us. What do you want to start with, Infosys or horrible set of IP data?
Whatever you decide to start with.
What do you think will have impact on markets today?
Nikunj, I think all these negative data, are known that when the whole world is or the whole Indian market is playing the long dollar short equity trade, some of that is getting reversed, and the reversal has not yet fully happened.
Price and the fact that IP data for the month of May was not strong, I guess that's not a big surprise.
Yeah, I think that when a negative data point hits you, you tend to take it in your stride, and most of them are known that manufacturing is collapsing, inflation is still high. You saw the CPI numbers; they came in higher than estimates, and still the markets went up. So the whole world is actually playing the long US dollar short equities trade as far as India is concerned, and some of that is unwinding, and we are not fully done with that. And that is what makes me feel that the markets have still some way to go on the upside.
Manish, for markets to keep on going higher, you need a constant and constructive positive news flow. But given the way or given the kind of macros we are working with and the kind of earnings which are expected to come in next 2 or 3 weeks, what will really generate upside momentum?
No, I think post Mr. Bernanke's comment about continuation of the stimulus program, I think it is the liquidity which is going to keep on flowing. So you will see more inflows by way of ETF, which will generate the beta in the market. So it will be the same old index odd names which will tend to move higher. So what is going to change is the liquidity factor.
What about Infosys then, Manish? I mean, has the stock hit a ceiling after the first day move of 12-13%?
Yeah, I mean, numbers were good, but one cannot really extrapolate these numbers into the next quarter as well, because we have seen the wild gyrations which Infosys sees quarter on quarter. So, and the management has also indicated that they are cautiously optimistic, but what they have delivered in the first quarter cannot be extrapolated into the second quarter. So, having said that, I think for FY14 at around these valuations, appears to be more or less fully priced at around 28 or 100 crores, unless and until we see some revisions on guidance on the upside or the currency depreciates further, which changes the opinion for FY15, etc. I think for the next one quarter, this 2700 to 2900 should be the band in which Infosys should trade.
What about the rest of the IT pack? Are you more hopeful of a better performance when it comes to TCS and more importantly a steady stock performance as well from the likes of a Tech Mahindra, TCS or for that matter a Hexaware as well?
I think TCS should outperform Infosys both on valuations as well as performance. So if Infi has come out with such great set of numbers, then TCS should somewhat do better than Infosys. And if that was to happen, then definitely TCS should also move higher from the current prices. So I think the growth trajectory for TCS is clearly better than that of Infosys. But that same cannot be said for Tech Mahindra. I mean, yeah, they're doing okay, and now the merger has taken place. So I don't really see too much of a re-rating on Tech Mahindra from these current prices, unless until we see the performance improve at the blended level, both Satyam and Tech Mahindra put together. The telecom environment continues to be very weak, and that is bulk of their business. So let's see how Tech Mahindra reports numbers, but there is no scope of valuation or prices to earning multiple expansion for Tech Mahindra.
Manish, three sectors where markets currently are hiding in are A, pharma, B, IT, and C, some would say consumer names. Whereas for pharma and IT, because of weak rupee, numbers will be strong. But do you think because of a weak rupee, it could be a tough quarter for large cap consumer names because they are also dependent on palm oil and other important ingredients?
See, commodities in the international market have corrected, but the benefit of that may or may not be seen as far as raw material prices of consumer companies in India are concerned. So we got to look at consumer companies from the point of view of price elasticity. Where there is less price elasticity in demand, then those companies will tend to do better because they will have pricing power for their products. They'll raise prices and cushion the impact of raw material price increase in rupee terms. So I think the FMCG basket as a whole should tend to do better because there you have relatively less price elasticity in demand. Whereas the other consumer discretionary names, we are already seeing that in autos, volumes are coming off a cliff, and some of the other names also you would see, the top line actually not growing and there being a pressure on margins. So it has to be a case-by-case basis, but within the consumer space, clearly it would be the FMCG which should still deliver 15 to 17, 18% sort of a profit growth for this quarter.
Manish, you specialize in the mid-cap space and your fund, the next trillion-dollar opportunity has done rather well. So tell me a bit about your fund. What are the three holdings and what do you like within the mid-cap space?
Yeah, I think the fund has done well. It is a 5.5-year-old fund and returns have been quite good. In fact, the absolute CAGR returns over the last 5.5 years has been 12% when the markets, and we launched this fund at the peak of the previous bull market. So markets are still down and have not achieved the levels. They are not even at par, but this fund has delivered absolute returns at 12%. So 1 rupee invested in December 2007 is worth 1 rupee 80 paise today. So I think the key main things that we follow in this fund is basically buying to structural names rather than focus on cyclicality in sectors, and look out for companies which can generate ROEs of 20 to 25% and companies which can double their profits in 3 years. So we have just stuck to this philosophy all along and it has worked for us. I think some of the names that have done well for us, Page Industries, it's now an 8-bagger from an initial buying price. We have a Glaxo Consumer, which is almost a 1-bagger, Eicher Motor, which is a 3-bagger. So some of these names have done well and that has helped the fund perform to whatever levels it has achieved till now.
What about frontline auto names though, Manish? Because that's where seems to be the crux of the problem is. I mean, pick up any issue and that seems to be, currently ongoing, be it a labor unrest, production slump, as well as, sales data as well, sort of petering out. Is it time to avoid the frontline auto names right now?
Yeah, each of the auto names are actually going through their own set of problems. So whether it is JLR, it is to do with China's slowdown, and now there is skepticism that JLR volumes may not be as strong as what was being thought to be previously, or Maruti, which is, in spite of yen depreciation being felt, is not seeing the volumes come off and consumer disposable income is taking a hit on actually volumes on the passenger cars. The same is the case with automobile. So the short-term blip is there, you could see some valuation correction, but the outlook for the medium term continues to be quite good, particularly when monsoons have been very robust. So second half of this year, as far as rural India is concerned, motorcycles should see a dramatic increase in volumes. So if you want to play for the second half, then I think the two-wheeler space would be best positioned. Unless and until things improve here, as far as the overall economy is concerned, maybe passenger cars would remain slightly muted. And HCV is a huge supply being excess in demand, and that has directly to do with the economy. So long-term trajectory is okay. Medium term, I think two-wheelers should do better than the passenger cars.
If we recovered on the Nifty, that is important, that if we are falling less and we are gaining more, all declines are clearly getting gobbled up, and clearly it's the dip buyers who are once again dominating Indian markets. Manish, so let's look at your core holdings, Page Industries, Eicher and Glaxo Consumer. Now, they are expensive stocks and one would argue that they are some of the most expensive stocks listed on Indian stock markets. So you own the most expensive part of Indian stock market. Why is that?
That is the dichotomy, Nikunj. Quality comes at a price. We know that, and some of these names that we have are very high dividend paying companies. So, there is a correlation between high dividend payouts and high prices to earning multiples. So, prices to earning multiple is basically mathematically you can derive this is basically your payout divided by your dividend yield. And dividend yield on the market or the particular stock always remains at anywhere between 1.5% and 2%. So if companies are paying out 75-80% as dividend, and you have a 2% dividend yield, the justified prices to earning multiples stand at anywhere between 35-40. Having said that,
are you happy to pay this kind of a premium? You don't think there is a bubble in these expensive consumer names, because names like Nestle, Glaxo Consumer, Page Industries, they're trading at P multiples of 30 plus?
So they are not in a bubble zone. I am very clear about this because the earnings growth will take care of the valuation. We are looking at trailing earnings. You are talking about, let's say, a 40 times on a page industries. But what about the growth? You know, the company is actually doubling its profit every 2.5 years. No, so 2 years down the line, valuations at around 20-25 P for a 50% ROE company and a 50% payout company.
Okay, Manish, good having you on the show as always.